And for those of you that can't see the presentation slides, if you're looking at a phone, just to click on it and you can hopefully see the fact that what we want to do is just give a kind of a general introduction into Alpha Wealth. And then, as I say, Ian's going to run through several areas and he's prepared some slides, which I'll be doing the slide deck for him. So apologies in advance for my slowness in moving those along. For those of you that don't know me, my name is Nick Sharon-Ambus. I'm the Managing Director of a company called Alpha Wealth. We are a financial services company primarily based in Cork. We have a small presence in Dublin. We have 6 advisors based in the office here, myself and a colleague of mine, David Looney, who is also on the call. You can see us pictured there with Dermot Bannon, which was an event that we ran last year, which was quite a bit of fun. And I suppose just for those of you that have no, I suppose, history with Alpha Wealth, we effectively provide financial advice to individuals in several areas, primarily in relation to kind of savings and investments, which is what the focus of today is about, and also in the areas of insurances, from various different types of insurances, some of which we sell, some of which we don't, but we offer general advice on, and also in respect of pension planning, which again is relevant to certainly a number of people on the call today, particularly with those that have pensions with Zurich, and Ian will be fleshing out on that a small bit further. So I suppose without further ado, I'm just going to introduce Ian Slattery, who's an investment consultant for Zurich. Ian's been kind enough to give up his time today, which I'm very grateful for. I've listened to Ian on many occasions over the last number of years, and I have to say I've really been impressed by him, and I'm sure you will be too. So hopefully, Ian, you can hear me, and you're good to go.
Perfect. Thanks, Nick. Managing the expectations anyway. And yeah, I'm under strict instructions. I'll keep you for the 20 minutes, guys, where everybody's busy. So thank you, Nick, and the rest of the team for the opportunity to have a chat today, and for everyone else for joining on the call. Just as Nick mentioned, I work for Zurich Life. So we're a investment manager based in Dublin. We manage about 25 billion euro for Irish clients, such as many people on the call. And we're an active investment manager. And what that means is that we make decisions about what we think is happening in the world and what we think might happen as well. So again, we have an opinion. We're not always right. We have a decent enough track record on it. So today, I just want to cover a few things about what we've seen so far this year, a little bit about what we think might happen, and then a little bit just around 1 or 2 principles of long-term investing and some funds that we offer as well. So if I just go through to the next slide, this just tells the story of the year so far up until the middle of September. This is our own international equity fund. So this is a standalone fund that invests 100% in equities, which again is a type of an asset class. But it also forms a part of a lot of our multi-asset funds, for example, including the Prisma range, which many of you might be familiar with. It's been an interesting journey so far this year. Remarkably, equities are actually, with the Zurich fund, have outperformed the market pretty well, and we're in positive territory for the year. I think that's an interesting point to note, because we could look at the year returns being positive for 2020, and in a couple of years' time, we might just see that positive figure and think nothing happened. But it's been a seriously volatile journey so far this year. You see over on the left-hand side, equities are actually up 6 or 7% for the first 7 weeks of the year, building from a very strong 2019, so a really strong start to the year. Our own view was that markets had come pretty far, pretty quick, and something would probably knock them off track. We certainly didn't predict the COVID pandemic or anything like that. The markets peaked around the 21st of February, and what happened then was the fastest bear market, or the sharpest or quickest bear market in history. A bear market is characterized as a 20% fall from the peak. So we saw that in just 16 trading days in February and into March this year. So it would have felt like a shock to anybody who was looking at stock markets at that time, and it was. It was the quickest that had ever happened. And that peak to trough, the top to the bottom of that chart that we have on screen at the moment, is about 34-35%. So stock markets lost about 1/3 of their value in just over 3 weeks, or 3 calendar weeks exactly. So again, a big shock, but we have seen a very strong recovery. What we saw from the 21st of March through was the best 50 days ever for the US stock market, best 50 days in history. So coming off that low peak, we saw a really, really strong rebound throughout the second quarter of this year. Things stabilized a little bit over the summer. This is in euro terms, so currency fluctuations had a part to play as well. And you can see just where I have that 2.98% on the right-hand side, we've seen markets come off a little bit so far in September, and that'll certainly help when I have to get the crystal ball out in a few minutes to talk about what might happen in the future. But overall, a really short, sharp shock. But the recovery has been equally impressive in some ways. Markets haven't recouped their high of the 21st of February, but are in positive territory for year to date. And if you think about what we're trying to get off equities or off a relatively high risk return per annum, you could be pretty happy with 6 or 7%. That's what history tells us for equities or a high multi-asset fund. And again, there's actually the potential that we get there in 2020, which would be remarkable given everything we've seen. So that's kind of the story of markets as a whole. And there's obviously the opportunity to have a few questions on that in a few minutes as well. But if I just come through to the next slide, I'll just talk a little bit about what we've done. I always give myself a hard slide to just test myself about how well I can explain things. There's a lot going on in this, but it breaks down pretty simply, actually. So when I mentioned equities as one particular asset class a few moments ago, we invest across different asset classes. We take this multi-asset approach, and I know Nick and the rest of the team would take that approach as well when you're looking at funds. You don't want all your eggs in one basket. Different things will give you different returns at different times. So what we have on this particular chart is we have blue at the bottom, which is equity. So that's the predominant amount of what we would invest in. You have different types of bonds, which are shown in the green and the gray just on the right-hand side. We have property in the purple. We have alternatives or commodity investment in the lighter shade of blue, and then orange on the cash. We don't hold much cash at all in this particular fund. But the point I'm trying to show here is you can see the bars move up and down as we go through time. So each of these bars is 1 month in history since February 2015. So what we're trying to do is, as an active manager, when I used that phrase earlier on, is pick which of these asset classes we want to be in at different times. And if you just take a look at the last couple of bars on the right-hand side, I'll just talk a little bit about what we've done so far in 2020. We actually increased our equity content in February and March of this year. And that might seem like a strange thing to do as we were coming into a bear market, but we felt two things would happen. We felt, just before I say anything here, I'm speaking about the pandemic purely from an economic perspective. I'm not belittling the health or the societal impacts at all, but we're looking at it through a cold, hard investment lens, I suppose. So we felt that the losses or the drawdown we would see from the pandemic would be overdrawn. We see the same characteristics in investment markets as we go through history. And we've been managing money in Ireland for over 40 years. So the reason for this market collapse was different. We hadn't seen a pandemic like this in 100 years, but you see the same characteristics. You see the same investor behavior. You see the same capitulation in terms of investor confidence. So we actually added to equities throughout February and March. That would have hurt our performance before we got to the peak. We didn't time that perfectly, and we don't claim to either. But that meant we were able to participate fully in that recovery that we saw since. And another big reason of that is policymaker action, and with this kind of concept of don't fight the Federal Reserve, which is the central bank in the US. We felt central banks would help, they would come to the rescue. And that's part of the reason why we added to equities at that time. And we had a very high equity content for most of the second and third quarters of this year. If you look over on the right-hand side of the chart, the last 4 bars, you can see that blue piece coming down. So that's us twice in July and once in August, reducing the equity content of our funds. So I'm just using one chart here, but this would have been replicated across all our multi-asset funds, which you might invest in with Nick and the team. So again, we were making decisions in advance of what we might see. We still think equities are the best place to be, and I'll touch on that again. But we were coming out of equities at a time where other people were starting to go back in. Okay, so we're trying to make those decisions, and we're not trying to predict the future, but you're trying to participate in what you see in stock markets. I just want to talk a little bit about that blue bar, that equity bar, because what we've seen in the equity market so far this year has been really, really interesting. So if I just go through to the next slide, I want to talk about why we saw that recovery, and particularly within equities. And I just have 4 points here, because this is a question I ask myself quite a lot, and I know I've attempted to answer it at various points in the last number of months. The makeup of the stock market is really, really important, okay? So when you talk about this disconnect between what we see in the stock market and equities and what we see in the economy, if you think about the types of businesses that are hardest hit by a lockdown, they're small, medium enterprises. They'll have a local customer base, and they probably won't have an online presence, or not a significant one. They don't have robust supply chains, and they don't have access to increased capital from banks or stock markets, whatever it might be. That SME cohort is really, really important to the global economy, and especially within Ireland. However, one thing about SMEs is they don't list on the stock market. So again, the types of businesses and businessmen and women who are most affected by the lockdown weren't necessarily on the stock market. Bits of the stock market were very, very impacted, but a lot of those bigger companies had balance sheet resilience. They had a lot of cash. They were able to raise money as well. So again, you're not buying a direct slice of GDP when you invest in the stock market. You're buying a slice of the business activities of companies on the stock market. Now, that's an absolute mouthful, but it goes a little bit of the way to explain some of the actions we've seen in markets so far. Second point is stocks are forward-looking. Stock markets don't look at what happened yesterday. They look at what's going to happen tomorrow and the day after that. You're discounting cash flows into the future. You're buying something today on the expectation it'll give you a return in the future. So when why we saw such a strong rally at the end of March and into April, people were looking into the future, and they felt that this was the worst is behind us in terms of the equity markets. So again, stock markets they lead the economy. They're looking forward before we see all the bad economic data that's been priced into stock markets. I mentioned don't fight the Fed, or don't fight the Federal Reserve. The action of policymakers has been massive. It's the biggest issue, or the biggest reason why we've seen such a strong recovery. I'm talking about both fiscal action, so think about the 350 quid a week payment in Ireland. That's an example of government or fiscal spending, but also monetary policy. When I say monetary, I'm thinking about central banks, about interest rates, things like quantitative easing, which didn't exist 10 years ago, okay? So policymaker action, two things about it. It was really quick and it was really big. We're talking about it in the trillions with a T, and it was quite a quick reaction as well. A big point though, and as an active manager, there's clear winners and losers, and I mentioned that as well in terms of the makeup of the stock market. There's clear parts of the market that we felt would do well throughout the pandemic in terms of an investment opportunity, and there's clear parts of the market we didn't think would do particularly well. So my next slide just shows that kind of spread between the best and the worst performing sectors of the stock market. So when we look at equity investment, there's 11 sectors underneath. 4 of them are up on screen at the moment, but you've got the likes of financials, energy, consumer discretionary, technology, healthcare, consumer staples. Okay, so there's lots of different buckets you can put companies in. But energy stocks have been massively hit this year because of the oil price. Financials have been massively hit because lower interest rates, any kind of bad debts or defaults would affect financial institutions. And the other side, consumer discretionary and technology have done really, really strong. And we've been trying to capitalize on those biases, because if I just pull up the next little bit, you'll see that spread of 60%. That's massive. And what I mean by 60% is that's the difference or the spread between the best performing sector of the stock market, which so far this year has been technology, and the worst performing, which is energy, nearly 65%. So that volatility or that differences creates opportunities for investment managers. To put it really simply, we wanted to invest in companies that could capitalize on work from home, play from home, and deliver to home. They're the sorts of companies we were looking to invest in the last number of months. And that goes a little bit of the way to explain some of our really good performance as well. And having that ability to identify winners and losers is really, really important for us. Because what we're trying to do here is return money and return capital to clients and customers such as yourselves. So again, different parts of the stock market have performed better. The technology, consumer discretionary, and the healthcare sectors have done really well this year. They've been the areas we've been most exposed to, and we've been underweight or had less exposure to the likes of financials and energy. Again, when I look at stock investment, what we're trying to do is we're looking to see a glimpse of the future here, okay? So what we're actually seeing is, I mentioned earlier that stocks are forward-looking, and they're trying to discount cash flows into the future. A big thing that we believe that we've seen so far in 2020 is an acceleration of a number of trends that we thought would materialize throughout the 2020s as a decade. And we've seen the acceleration of the digitization of the economy. We see the first cohort of school leavers or third level leavers joining the workforce working from home. Millennials have made way for Gen Z, the Zoomers. And we see a bigger focus on healthcare and bigger government potentially coming on the back of a health pandemic, and tech wars and 5G and things like that. So I'm not saying everything on this particular slide holds true or that it all comes true, but we're trying to just identify some of these trends that we might see into the future and invest in those companies now to gain hold of those future cash flows that helps our fund performance. So I'm happy to take any questions on these at the end, but it's just a couple of ideas or things that might materialize after the coronavirus. If I just go through to the next slide, I just want to talk a little bit about the makeup of the stock market and what we see as investors. People always talk about the US market's the biggest in the world. So if I took a pie chart of the total stock market of the globe, about 65% it would be in the US. So really, really big deal. However, geographical allocations don't tell the full story. I've just taken 5 of these mega cap tech stocks. They're all household names you can see on the left-hand side. But I'm just making the point here is that where a company is domiciled doesn't tell you everything about where its profits are from. If I take the likes of Facebook and Apple, more than half of their revenue is from outside the US, as the same with Alphabet, which is the parent company of Google. A little bit less for the likes of Amazon and Microsoft, but still a really, really a large percentage, over a third for Microsoft and almost a third for Amazon. So again, one of the things we're trying to do as investment managers is not just look at where a company is domiciled, but looking underneath the surface. What's their sector? What's their business model? How is that going for them? What areas of the market in terms of the globe are they actually investing in? And the same, you can say the same about some Irish companies. If you look at the likes of CRH or Ryanair, amongst others, of course, but Irish domiciled companies that are global players. The large majority of their profits are derived from overseas. So again, it's just an interesting point. We often would have talked in the past about we like America or we don't like Europe or whatever it might be, but that sector story and the business activities and where profits are from rather than where a company is domiciled is a really, really important aspect of investment markets at the moment. Another big point that we're seeing at the moment is just this particular slide, this concept of market concentration. And what I mean by that is I have those mega cap tech stocks before. They're becoming a bigger piece of that pie, a bigger piece of the global stock market. However, whilst it's getting bigger, it's not unusual, okay? So what I have here is the percentage of the total stock market that the top 10 stocks make up. So for example, in 1930, the top 10 stocks in the US market made up 27% of the total. That actually grew for a number of decades before tapering off towards the back end of the last and the start of this century. And it was up at 22% at the start of 2020. That is a little bit higher now. It's about 24, 25%. But market concentration has always been there. And again, as an active manager, we can identify that. We can invest in these top 10 companies, but we can also make a decision not to or hold less of them if we wish. But stock markets, I suppose, we talk about tech as a new term these days, and Amazon and Apple and Tesla, which we don't actually own any Tesla, for example, but we talk about these kind of tech firms. But technology has always been there. And again, that forward-looking nature of stock markets, you're trying to capitalize on companies that you believe are innovative, have a good business model, have good business ideas, and will do well in the future. General Electric would have created the halogen light bulb back around World War II. That was the tech at the time. Ford and the Model T, that time before with the invention of the motor car, that was the technological advancement at the time. So again, we always expect winners and losers. We always expect companies that can do well and grow their profits and grow their market share to do well over time. But I just wanted to make that point on the market concentration. It's something we're aware of. I think it's getting a lot of airtime and press at the moment. It's not necessarily a good or a bad thing. It's just something to be cognizant of. If I just go through to my next slide, I just want to talk briefly about one of those investment principles. There's a couple of key investment principles that we look at in Zurich about how we manage money. And I know Nick and the rest of the team at Alpha Wealth will certainly wouldn't disagree with any of them about taking a long-term view, about having a plan and sticking to it. And another one that's very important is how you gain access to stock markets. So for example, if you're a monthly pension investor or a regular saver, you're buying in at different times. So if you think every month you get paid or every fortnight or whatever it might be, that's when you put your premium, or that's when you put your money into your Zurich or whatever account it might be. That's actually really, really helpful for investing when you see volatile times. That kind of dark blue line is the actual performance of stock markets at the back end of 2018. So you can see it went up and down. It troughed as such, or the bottom was at the end of December, and it recovered again. However, if you were a monthly investor, each of those red dots that I have is when you would have actually invested in stock markets. So you didn't put all your money in October 2018 when the market was at a high, albeit you didn't put all your money in at the start of January when it was near the low. But this is this concept of unit cost averaging. You're averaging out your exposure over time. Okay, so you're not taking a big bet about what time or what day you're going into the market. So again, that's something that naturally comes with regular saving and regular pension investment. And it's really, really helpful. It's a really, really important piece for investors. Just last 2 minutes from me, just on to my next slide, or my last slide is just our current outlook for investment markets. We do have a preference for equities. We still believe equities are the best place to be versus other asset classes. We are aware that equities might look expensive versus history in terms of price earnings multiples or some of these other things that get quoted. Equities have fallen over the last number of weeks. We would characterize that as a healthy move. As much as we would like them to go up in a 45-degree angle the whole time, we know they won't. So again, just a little bit of a pause for breath is something that we would see as a positive for markets. It makes the whole rally sustainable. And my second point is credit over sovereign. What I mean by that is when we're holding bonds, we prefer to hold the bonds of companies rather than the bonds of countries. Why we believe that is we believe we can have an active selective approach which can add value, and we believe the extra interest rate that we will get from company bonds is a better return for us and our clients and our funds than the interest rate we get on government or sovereign bonds. And that's to do with the interest rate environment in the world. In terms of within the equity book, growth over value, what I mean by that is we prefer growth stocks, technology, consumer discretionary stocks that have the potential to grow their earnings rather than those that are more defensive and pay a dividend. And we prefer Europe over the US on a geographical basis. And a lot of that's to do with some of our interpretation of currency movements as well. But just to finish off, just two points I did want to say was our performance has been strong, and again, Nick and the team will be able to bring you through that on a case-by-case basis, particularly our Prisma funds, our multi-asset funds that we're trying, that's what sees the majority of our flows. A lot of our equity funds are positively exposed to the technology sector. That's an area that we like. One other thing that we will be bringing on board on the 1st of October is a top tech 100 fund that invests directly in the NASDAQ 100, which is where all the main tech stocks are listed in the US. So again, that might be an option for some people looking at the regular savings. So again, just a little bit on the fund side. But the last point for me is this concept of relative valuation. When we look at where interest rates are in the world, at record lows, negative interest rates, negative deposit rates for companies and now for individuals, we believe that helps equity investment. We believe that equities is the best place to be. It'll be a bumpy enough back end of 2020, and there might be a question or two on that. But into the medium term, we believe equities are the best place to be in a multi-asset space. I think that's about 19 minutes, 55 seconds maybe, Nick. So with that, I will just pass back over to you.
That's great, Ian. Thank you very much for that. I do really appreciate you putting the effort and time and always the knowledge. So what I might suggest now is I'd like to kind of open the webinar up to any questions that anyone might have. Just to remind anyone who wants to ask a question, just unmute their microphone, and feel free to maybe use the opportunity for the next few minutes just to ask Ian any questions you might have.
Or if you disagree with anything, that's always interesting.
Hi, Ian, how's it going? David here from Alpha Wealth. Thanks a million for coming on the call. I might just get the ball rolling. Ian, you mentioned obviously that Zurich are very pro to technology companies, and I was just interested in getting your views on I suppose the stock prices of some of the main technology companies like Apple, obviously they've been on this, very impressive rally since, kind of the market low point in March. We're just kind of wondering, I suppose, do you think that there's a possibility that the prices of these stocks could be very inflated, or is there real growth there? And I suppose, secondly, do you think that the funds are, very over-reliant on the valuations of these companies?
Yeah, no, it's a great question, and it's one we've been answering or trying to answer. I think firstly, just on one of the comments I said a moment ago, I think the recent falls, whilst 6 or 7% falls don't feel nice in the short term, it does make the whole thing a little bit more sustainable and takes a bit of the froth off the top of the markets. So I think that was due, and I think that's a relative positive. In terms of those top 10 tech stocks, we would be slightly underweight a couple of them. So for example, we don't hold the market weighting of Apple anymore. We still do hold Apple, but not the full weight. So we are aware that they went too far too quick. So we would share that concern. And again, that's some of the active management we could do. The last point, the last point of your first point is around, say, valuations. The last time we saw technology stocks this expensive, in inverted commas, was around the turn of the century with the dot-com bubble, and I'm sure many people on the call will be aware how that ended. However, around that time, interest rates were 5 or 6%. So again, when you're looking at the opportunity cost, or what it costs to invest in equities versus just leaving in cash, that was 6% back then, and it's probably 0 or minus in most cases now. That means we can stomach, as investors, higher valuations than you would look back at history. So again, whilst valuations will be above average, I suppose the first thing about an average is half the time you're above it, half the time you're below it. But the second thing is that we can tolerate or stomach, if that's the phrase I'd use, higher valuations in some of these tech stocks because the alternatives are so low. It has been, I wouldn't say perhaps reliant, but the main driver of returns for our book of equities and equities in general this year has been those tech stocks. But that changes. So we see tech leading the market at the moment. At some point in the future, those value stocks, those defensive dividend paying stocks will come back again. So I certainly can't disagree with anything you said there. And we will, I suppose, will react. As the market changes, we change our views as well. But broadly okay with a tech weighting at the moment.
Perfect. That's great, Ian. Thanks for that.
Thanks, David.
Are there any more questions at all?
Hi, Nick. Nick, Jimmy Daly here.
Hi, Jimmy.
Yeah, thanks, Nick, again, and thanks, Ian, for sharing your knowledge. Just 2 questions there. Why don't, in your Prisma fund, what is the reason for not holding more cash in the fund, number 1? And number 2, what influenced the drop in equities over the last number of weeks?
Sorry, could you repeat the second one there? Sorry.
What was the influence that equities have dropped over the last number of weeks?
The inflows.
Yeah. Why did they drop?
Okay. Yeah. Sorry. Perfect. The first one is the cash piece. We prefer to hold short government bonds as an alternative to cash. They yield a little bit better, and they have immediate delivery as well. So some of the short government bonds that we would have across the Prisma funds would be a pretty good proxy for pure cash, except with a little bit better yield. So there is an element of a cash or a cash equivalent in the fund. 2 main reasons I'd say about the recent drop in equities. Firstly, the Federal Reserve in America has supported markets quite a lot by saying that they're going to keep interest rates lower, and that relative valuation piece. There will become a point when equity markets have to stand on their own 2 feet again, and the fundamentals have to help equities as much as the policymaker action. Some comments in recent weeks from central bankers started to suggest they would be not supporting markets as much as they have in the past, and that caused a little bit of a wobble. The second point is that kind of phrase that I've said a couple of times already about that pause for breath. A few people started to take some profits and book some profits, and that caused the market drop as well. Just on it though, in general, there's been about a 7% drop in markets in the last number of weeks, and on average that happens twice a year. Now I know we saw a much bigger one at the start of this year, but those sort of movements aren't they're seen in markets, is what I'll say, from time to time. Yeah, they're not unusual. Sorry, that was the phrase I was looking for.
Yeah. Okay. Thank you.
No problem. Thank you.
I just have a quick question, actually, Ian. Will Zurich ever buy Tesla shares?
They drop about 80%, maybe. No, I know that was just one stock that I mentioned. We don't own any of that. Look, there's stocks that we own that have lost money. There's stocks that we don't own that have made money. So look, we don't have a pure view, and we've hopefully got enough humility to state that as well. We believe Tesla is an example of a stock that doesn't justify its share price in terms of the actual business model behind it. Lots of people have made lots of money off it, and that genuinely is great news. Like even the announcement from Elon Musk yesterday about the new battery wasn't necessarily as positively received by the market as it might be. I think the risk with Tesla is that they've got a lot to prove now. People have put their money into it, and they kind of have to back that up with profits and innovation. So we're not trying to make 100% for clients, or because we know we'll never want to lose them 100% either in terms of our funds. So I'd never say never, but it's not one that we invest in at the moment.
Okay.
Hi, Richard O'Sullivan here. Just a quick question. You mentioned there, Ian, that from the start of October, the Top Tech 100 fund will be available. Does that mean to private investors? It's already available to pensions, so is that coming available for private investors?
Yeah, that's what I meant exactly. So it's as you stated there, it's available on the pension products at the moment, and it'll also be available on our savings and investment products from the 1st of October. It's the same fund, it's just available on a wider range of products now. Yeah.
Okay, thanks.
That's a good point, actually, Richard. And it's something I suppose just to finish up on, to say, firstly, thank you very much, Ian. Again, I do really appreciate your time. I know how busy you are. Just to reinforce the fact that part of today's, I suppose, webinar was around maybe an education around where Ian and Zurich see the world and opportunities within that. The Zurich products, which a number of you on the call have, I suppose hopefully it's an endorsement of why Alpha Wealth would have, I suppose, promoted these products, and I'm pleased with the performance of them over a short, medium and longer term. There are opportunities, as Ian's just mentioned, around the Top Tech Fund from a personal point of view, and it might be an opportunity for those existing investors to look at this as one option, which David and myself can talk to clients about, or indeed for those people out there who may have funds sitting in cash that they may like to put to work either on a monthly basis or indeed a lump sum. And that could be either personally or through obviously a pension vehicle. So I'd like to finish up by saying thank you very much again to all of you, particularly you, Ian, for taking the time today. And there is a video and slides will be made available to those who would like to take those, particularly for those who may have come on the call slightly late. So thanks very much again, guys, and enjoy the rest of the day. Thanks very much again, Ian.
Cheers.
Take care.
Bye.
Thanks, Ian.
Thanks,
Take
Ian.
care.
Thank you.